episode of Always Up to Date. I'm Denise and this is Yahweh, and we are co-owners of Always Bookkeeping. Today we are going to talk about just some basic bookkeeping tips. We have a quote from Jim Collins, who's the author of 6 different books. And his quote is, "You must maintain unwavering faith that you can and will prevail in the end, regardless of the difficulties, and at the same time have the discipline to confront the most brutal facts of your current reality, whatever they might be." And the statistics that we have today is that 50% of all businesses are out of business in 5 years, and 29% of these failed businesses will cite that they ran out of cash. So we get new business owners that come in and see us, and they're starting a new business, and they, again, like we've talked about, they know their trade, but they don't necessarily know about bookkeeping and accounting. And so we just have a few sort of really basic bookkeeping tips that we're going to share with you today. Just especially if you're a new business owner, or you have just a small business and you're the one that's taking care of it. Hopefully these tips will kind of help you a little bit, just keep you on the right track to keeping your business going, so that you're not one of those statistics that run out of cash. So Yahweh, the first question that we have, as a small business owner, do you want to practice management accounting or financial accounting?
This is kind of a gray area. Technically, you should practice more of the management accounting side, because this is what's gonna help you make a better decision on what you want to do internally as opposed to externally. But the thing with management accounting is sometimes we don't have, or a small business owner especially wouldn't have the necessary resources to perform analysis on this matter without having the financial accounting done first. So financial accounting, this is mostly a focus on your financial statements, the one that your accountants issue you every year. These are more, it's made more towards people that are external or third party or out of your corporation. So these includes like investors or the banks that you're trying to get a loan from, your your CRA, like the tax authorities. Those are the ones that we'd be using your financial statements. Management accounting is looking more towards, if you have for example, inventory and stuff like that, then you want to make sure that you have the right margin and you're costing it properly. So management accounting is more about costing, pricing, more about like forecasting, in terms of how you want your company to be. So it has more emphasis on the planning side of things for a management perspective, as the name suggests. So if you do have the necessarily resources to do management accounting, do a little bit more analysis, then yeah, absolutely do management accounting and use that as your advantage to grow your business. But for financial accounting, if you only have the financial statements, there is a little bit more that you can do with the numbers using the financial statements that you have, and make decisions out of your actual numbers from there as well. So use your financial statement as a basis is what I'm trying to say. Yeah.
Great. So is there an easy way to figure out debits and credits?
This is it's very simple if you know the nature of each account. So if you have a good understanding of which accounts fall under what category, it's a lot easier to find out your debit and credit. What I mean by that is you have balance sheet accounts, which is going to be your asset, liabilities, and equity. Assets are normally on the debit side. So anything that decreases them, you will have to put credit. And equities and and liabilities are normally on the credit side. So anything that decreases them would be a debit. So if you have that distinction between like what accounts they are and where they fall on, for income statement as well, anything that's in revenue or adding revenue would be normally a credit. So anything like sales refunds and sales returns would be a debit because it's reducing revenue. And expenses are normally a debit, so anything that's decreasing them, or for example a vendor refund will decrease it, will be a credit. So it's really knowing where the accounts fall on which financial statement and which category. That's the key to knowing what should be a debit and a credit. And in a double entry accounting, there's always your debits and credit will always be equal, and has to be equal for you to have a successful bookkeeping strategy. Yeah.
Good. And so, Yahweh, do I have to keep all my expense receipts?
In a technical sense, yes. Yeah, you have to keep as much receipts as you can, but we normally recommend at least keep the ones that are over $100, because if you do have a lot of transactions that are going on in your business, most of the time for audit purposes, CRA would only require, let's say, depending on the sample size, they will just choose the highest. And if you're if you're a small business owner in Edmonton, most of the time it's over $100. So anything below that doesn't necessarily get required by CRA that often. Keep it for record keeping sake, but as much as you can, prioritize on the receipts that are over $100, because those are the ones that might be asked more.
Yeah, and I think we recommend keeping them for 7 years. Right?
Yeah, exactly.
That's how long the CRA has to go back to audit if they're going to audit. So
yes, that's
7
right.
years.
Yeah.
Yeah. So can I recover GST input tax credits pertaining to my startup costs?
Most of the time you can. Just make sure first that you're registered with GST before you start claiming it, because I know sometimes you incorporate it and you don't necessarily register GST right away.
Right.
You can still recover part of the GST or the ITCs that you paid for and backdate it. CRA is they're a little bit lenient on that, as long as it's within the same tax year. So yeah, you can definitely figure that out. There is a chance that you get a call from CRA though, just clarifying, because most of the time you'll get a loss on the first year and they'll say you have a lot of GST or ITCs that you're trying to recover. Just make sure that you explain to them that it is a purchase of an asset or a big expense that you have to capitalize because they have to be depreciated. So those kinds of stuff, those are the kind of stuff that you might need to explain to CRA a little bit further so that they can have a little bit more understanding, because their first basis is to look at your net income and your income statement and figure out the GST from the accounts on that, without necessarily looking back what's on your asset side.
Yeah. So we're looking at financial statements, Yahweh. What financial statement lets me know the financial health of my business?
So that would be your balance sheet. It is also called the statement of financial position. It tells you, it lists your asset and liabilities and equity. So mostly the asset should equal your liability and equity. Logic is you're either gonna finance it yourself through equity, or you're gonna borrow money, which is your liability. So that's the main purpose. Financial health would be measured by looking at mostly ratios between the relationship on those three main categories on your balance sheet. You'll be able to tell if you're heavy on financing, or you're more heavy on equity, which is you putting in money into the corporation. So that would be your balance sheet. That would be able to tell you that.
Okay. And so then what financial statement breaks down my profitability?
Profitability will come from your profit and loss or income statement. It'll tell you how much you made in revenue, how much your direct costs are, which are the costs that you needed to generate the revenue, and you can relate them to, and then your overhead expenses, which is your general expenses. From then you can see if you were profitable for the period that you're looking for based on how much is left in your net income or net loss.
Well, that's really what everybody wants to know,
Yeah.
right?
Yeah.
So we use comparative income statements and comparative balance sheets. Can you just explain a little bit what those are?
Comparative income statement and balance sheet. So it can be the period can be a lot of things. It's mostly just comparing one period to another. At Always Bookkeeping, we always provide financial statements bi-weekly using comparative monthly balance sheet and income statement on a month-by-month period, and we usually put 6 months ahead. It just shows you, it tells you a bit of what anomalies are there, because especially for the balance sheet, it's cumulative. So if you see something that's declining and suddenly on 1 month it's higher than usual, then you can figure out what happened. If you're able to do so, then that's great, right? That's really the main purpose of having comparative balance sheet. It's to see the reasonability and be able to compare it to your previous performance or even your forecast. Yeah. So
yeah, and lots of times we find that error, that maybe it was something that an asset or something, but it got posted to an expense, or vice versa. It gets posted in the asset account, and it should have been an expense. And so if you have the comparative, it's really easy to pick those out and see where that error was, just so that when you're looking back at your financial statements, you can see your financial health and your profitability accurately.
Yeah, absolutely.
Yeah. So how can you benefit from investing in an accounting system that works for you?
Well, first of all, if you if you chose an accounting system that's user-friendly, that saves you a lot of time and training, right? And really, for a small business owner, that's one of the most limited resources that we have is time. And you really want to focus on growing your business, opposed to the admin side of things. So that's one way to look at benefiting from it. Another thing is that accounting systems that are easily, that you can easily configure to other stuff that you might be able to use. If you're a contractor and you're using a project management system, it might provide you a lot of benefit if this accounting software will integrate well with your project management software. Or if you're using let's say a timesheet software for your payroll, it's a lot easier for you to or there's a lot of benefit in cost saving in having a software that integrates well with your timesheet program. So that's one of the stuff that really helps, especially for a small business owner who's just basically doing everything for all the different departments just to run their business. Yeah.
So, Yahweh, how can I keep tabs on what my bookkeeper is doing?
Yeah, so the comparative monthly and comparative comparative monthly balance sheet and income statement really helps you with this, because if you're seeing irregularities on your income statement month per month and your bookkeeper is not able to tell you or explain to you why that is, then that means she doesn't know or he doesn't know enough about your industry or even the bookkeeping itself to explain to you what the anomalies are. And that's really a bad thing, especially if you're relying on these reports to make your decision. Like, what if cash is more than what your bank is showing you and your bookkeeper wasn't able to explain to you why that is? Then you might do a big purchase based on your reports without you know, knowing really that the accounts are inaccurate, then that could cost you a lot of money.
Yeah, that's right. Finally, how can I keep track of my mileage?
Mileage, we would normally tell them or tell our clients, if you don't do a lot, the least you can do is to estimate how much you drive, business that's business related. But if you really want to keep track of mileage, we suggest you look at where you're going, and where you're coming from, and the number of the number of kilometers it took you to get there, the date, and the purpose. Those are the main things that you want to keep track of. It doesn't necessarily have to be perfect. Just even get a notebook to do it, or Excel. Excel is better because you can probably use like a Google sheet that's cloud based that you can access anywhere, as opposed to a paper where you can lose it, or it can get destroyed pretty easily. So
and I think there's lots of apps out there
yeah,
as well
exactly.
that do mileage.
Or one very good strategy to use is your Google Maps. If you use your GPS a lot, it shows you the history. So it tells you the date, the where you went from and where you went to. All you have to know is the purpose, which will kind of tell you based on where you went, right? So
one thing that I just wanted to say that I think a lot of people don't know about, or maybe don't understand, is that you can't count mileage just going from your home to your office. That you can't claim that. That's just regular business. So going home from your office to home at the end of the day, that's not considered mileage that you can use for your business. But if you do an errand that's business related, or if you go see a client or something on your way home, then you can use that mileage. But just not going from your business to your home, or your home to your business. So
absolutely. The main logic is that if you would have been an employee, you would have had to travel.
That's right.
The same way, so you can't really use that for business purposes.
Exactly. So I think that's all we have, Yahweh. Those are all the questions that I have.
Awesome. Well, I hope you guys find it informative. If you have any questions or concerns, please do not hesitate to comment down below. Please like and subscribe if you love our video, and we'll see you guys next time on our next episode of Always Up to Date.